that's less valuable to some people and more valuable to others, especially at specific times like during football games when everyone wants wings or pizza but doesn't want to miss any of the action on the field. With the point being that in many cases, it's hard for some folks to justify the cost of food delivery if it's only saving you 10 or 15 minutes of time to pick up yourself, while others are addicted to the habit or use it heavily, at least on the weekends. And as a result, it's hard for delivery companies to consistently capture the consumer surplus they create while also having the service be economical at scale for millions of users. But scale is also essential for the economics to work in this business. So you might notice a pattern by now. There's a bit of a chicken and an egg problem. And the result is that as DoorDash has scaled the business, they spent more than a decade burning billions of dollars in accumulated cash, yet they've finally shown evidence of being able to generate an operating profit for the first time this year. The limiting factor for them is that they can only have so large of a take rate on every transaction while still sharing enough of the pie with delivery drivers and restaurants for it to be mutually beneficial for all the parties involved, including also not making the cost of food too expensive for customers. And then, from a business perspective, for DoorDash, you also have to manage the logistics of coordinating with customers, deliverers, and restaurants to ensure that the food gets to where it's supposed to be on time and without getting cold. And I think you just see by now it's a tough business to be in, honestly. And you have to almost perfectly thread the needle to make it all work. And I think that's probably not the most inspiring setup for a stock pitch that we've ever have here on the show. But incredibly, DoorDash has finally seemed to crack the code on making the unit economics work while the top line continues to grow at almost 30% a year over the last 3 years. And I think that's why you, Shawn, bought the company for us to pitch today.
Yeah, obviously, it sounds like another business we've covered on this show, in Uber, where the fact that they burn cash for so long is almost a moat in a way, because it was such a bad business for years before a certain scale was finally reached. And you'd almost have to be crazy to try and compete with them from scratch. And of course, Uber has Uber Eats. So beyond just ride hailing, they very directly compete with DoorDash and restaurant delivery. But to both of their credit, these companies, following actually different approaches, have made the unthinkable work. As you said, they've made these very difficult businesses actually profitable. And very few people at any point in the last decade, I think, would have told you that DoorDash or Uber looked like good businesses. By every traditional metric, they looked absolutely terrible. And at the same time, still, they don't have the same operating leverage as some of these other big tech companies in the Mag 7 that have dominated markets today, because there is a significant variable cost component to their business model. For the most part, every time another ride is hailed or another delivery order placed, that does mean a real person in the real world has to go out and complete that order. So there is something of an incremental cost to business that grows each time revenue grows, and that limits their profit margins structurally. But beyond just simply wanting to understand one of Uber's competitors better, since obviously Uber is a pretty core holding in our intrinsic value portfolio that we've been building on this show over time, I do genuinely see some interesting things going on at DoorDash. Now that they've proven that they can reach profitability while the business is still growing rapidly, you can definitely start to get really bullish about how further scale will support profit margins, and how with autonomous delivery vehicles and drones, they could actually dramatically improve their cost structure by cutting out human middlemen on the margins. And again, I think that will sound very similar to the thesis for Uber for anybody who remembers that episode we did a long, long time ago, it feels like now at this point. The other thing is that their rise to dominance was really unexpected in its own right and just impressive. It's a really cool case study. Grubhub and Uber Eats were by far the first movers in this industry, but DoorDash had this unique strategy that I think we'll talk about more that allowed them to gain market share sort of on the periphery and then surpass the incumbents in food delivery relatively quickly once you had this big catalyst in the pandemic rear its head in 2020, as we all know. And beyond the strategic differences in the approaches they took to growing their businesses, there was also just a certain amount of hustle and startup mentality that I think really defined the ethos of this company. And it made it so special in such that they're able to do much, much more with fewer resources.
Before the episode, you told me a lot about the founder, so I'm interested to hear about all of that. But before we get into it, I do want to linger a bit on the origin story, because this is one of the more fun ones that we've come across. I mean, last week we covered S&P Global, which is a company with a very extensive history. That's not the case for DoorDash. But what's interesting about DoorDash, to me at least, is that it very tangibly arose in our lifetimes as one of the first ever smartphone native businesses in the world. And growing up as a business in a world that's pre iPhone versus post iPhone can really shape the mold of the company in just unique ways. And like I said, DoorDash was one of the first tech darlings to go mainstream in recent years that was born into a world where smartphones were nearly universal and every single person has one. So that's pretty interesting to hear about.
Well, I do think it's a cool story. And I also think that listeners will notice how smartphones have impacted the company, either kind of directly or indirectly, as we work through the thesis here. It's not like nobody had ever thought of food delivery services before, but without smartphones, it just was not possible to make them work from a customer convenience standpoint to just managing the logistics. And so, yeah, to get into the origin story a bit, DoorDash, as we know it, started as Palo Alto Delivery. It was actually born out of a class project at Stanford where they were trying to test a minimum viable business product idea. And after meeting with dozens of local businesses, the one insight that emerged for them was that some businesses were turning away orders because they didn't have the funds to hire dedicated delivery drivers. And there's a story of this one woman in particular who was running a macaroon business and leaving a significant percentage of her orders unfulfilled because she was a sole proprietor and she couldn't run the shop and also make deliveries at the same time. So all the deliveries were rejected, but the economics didn't quite make sense for her to hire a devoted delivery person either. And for a really small bakery or restaurant that typically operates with only a few weeks worth of cash on hand sometimes, even just a few dozen extra orders a week can actually be the difference between survival and failure. So the early founders of DoorDash just started doing deliveries themselves on behalf of local restaurants in the area without even necessarily getting their consent. They put restaurants' orders on their website online. People would then call them, and then they would take down the orders and call the corresponding restaurant to actually place the order. And so once it was ready, they drive over, pay for the order themselves, and personally deliver the order to the customer's house, where they then collect payment from them using one of those little square card readers. And with just 4 founders, they spun up a business and got their first orders by basically blasting promos across various Stanford email lists about this new food delivery service for any type of food, not just pizza, which was really kind of the most common type of food that you could almost always count on being able to get delivered back then. So yeah, that's how it started, very humbly.
What I love about this story is that business ideas today, at least I feel like that, are only considered good when they are both asset light and immediately scalable. And this time, you had some college students arbitraging food orders and deliver them themselves. And that's many things, but it's not obviously scalable and asset light. And in hindsight, it's funny that pizza restaurants had done first party delivery for decades, yet a more widespread third party delivery had never really arisen for other types of restaurants. But then smartphones enabled customers to place orders just anywhere at any time, while deliverers could also get real time notifications about where to pick up and drop off orders. And you can see how this made it possible for third party delivery companies to emerge once smartphones just simplified communication between restaurants, drivers, and customers. And people had tried, as you mentioned before, similar ideas before, but without that technology, it just wasn't efficient enough to make the economics of the business work.
And in the beginning, it was not some sleek app that you probably imagine now. I mean, it was literally just a couple of folks working their butts off and coming up with these really novel band-aid solutions to all the different challenges that could arise. I mean, you could imagine a lot of small things went wrong in the early days. And so it was not some engineering brilliance that really set them apart initially, but it was just the sweat and tears that they were willing to put into making those early deliveries work. And like we've alluded to, they did leverage smartphones in ways that actually enabled the service to work reliably. And they did so really creatively. One of my favorite examples is that they would track each other's locations using Find My Friends on their iPhones. And that allowed them to see who was closest to a given customer's order. And then that person would be selected to go in and fulfill it. And it was from those just super humble origins as a class project that DoorDash would then turn into this $100 billion business that it is today. And all along the way, yes, there were ups and downs. And DoorDash's founder, Tony Zhu, Andy Fang, Stanley Tang, and Evan Moore ended up doing 4 rounds of seed financing, mostly led by Sequoia Capital, which is pretty famous in venture capital circles and is actually still one of the biggest shareholders to this day. But yeah, no one really thought it would be possible for them to raise enough capital or really just make the unit economics work. But by the time of their Series B fundraising round, their growth metrics were off the charts, which was actually almost a problem for them because their success was so rapid. DoorDash got this massive multi-$100 million valuation that the folks at Sequoia were worried they'd never be able to grow into, or at least not be able to grow into without taking a down round along the way, which really is a nightmare for these hot startups, especially when there's already serious concerns about whether long-term the business can ever be profitable. And I say that because the expectations among founders and VC investors is that every time a fresh round of funding is raised, the implied valuation of the startup should rise significantly, reflecting the startup's success in between those rounds. And otherwise, the idea probably just isn't good enough and will die if the business isn't becoming dramatically worth more over time. And so they actually rolled the dice and moved forward with this really lofty valuation where they knew that if they could not justify it to future investors, they might never raise funding again and the business could just go under despite having underlying success. And well, when it came time for another round of funding, because, they were basically just incinerating cash at this time, they're nowhere near profitability. They didn't think they'd be able to get any funding because even though, like I said, the business was doing great, the market sentiment on food delivery services just dramatically soured because so much more competition had entered. And they ended up effectively taking what was a down round where they raised money at a lower valuation just to stay afloat.
From what you told me, that could have really kicked off like a death spiral for DoorDash. And my understanding is that many of the early members of the company knew that too. So you had some early employees actually leave the company after the down round, thinking that the writing was basically on the wall and was only a matter of time before DoorDash blew through all of its cash and just couldn't raise enough funding to subsidize their growth, especially when they were going up against these massive competitors like Uber and Grubhub.
So the thing about a down round is that by raising more cash at a lower flat valuation, everyone already with shares in the company gets diluted significantly. And that is common in venture capital because as an early employee, basically you're expecting the company to grow fast enough in valuation terms to more than offset that continued dilution from selling more equity to fund the business. But when the fundraising valuations aren't growing, then you're just getting diluted with no gain. And that is a tough pill to swallow. That's why these down rounds are a nightmare that they really want to avoid. And so your shares are worth less and the company isn't worth more. And that's what causes the panic. And by 2019, though, they had done well enough to get term sheets from both SoFi and Sequoia, which both offered them hundreds of millions of dollars each. And as they were trying to determine which deal to accept, they had this crazy idea of, hey, what if we actually accepted both? And that came at the price of even more equity dilution and some loss of control over the company's board for the founders. But they knew that it would give them enough cash to think that they would really maybe never need to do another round of venture fundraising capital again. And so naturally, they dumped much of that cash into marketing and customer acquisition. And that was like the equivalent of slamming their foot on the gas pedal, just driving as fast as they could, hitting the acceleration. And of course, that couldn't have come at a better time because a few months later, the pandemic would hit and DoorDash received an unprecedented boom in order volumes with everyone locked at home. And they saw huge amounts of market share from their competitors at this time, rising from something like 17% market share to 50% market share, partly just because they'd found this winning formula for success in suburban markets that everyone else had neglected in favor of focusing on city centers. And also because they'd just been so patient about their growth that when they did finally rev their engines, it was almost exactly at the right time to do so.